Hello students, welcome to the online mentoring session. Today's mentoring session is for final course Paper-1 Financial Reporting, and the topic is in continuation to the earlier previous topic, which is major changes in Ind AS vis-a-vis notified existing accounting standards. I am CA Shilpa Agrawal, accounting faculty and your mentor for today's session. Before starting with the PPT slide, first of all, let me take up the query which was placed to me at the time of registration by the students on the Google Hangout. The only query which I received was that whether students are in a dilemma whether they are going to questions on India's will be a practical or theoretical question. So in this regard, we would like to state that differences vis-a-vis existing accounting standards and Ind AS and carve-outs in Ind AS from IFRS is the main portion where we are asking you or advising you to focus on or concentrate for preparation. So students, this portion is mainly a theory part. So we are expecting a theoretical question will be asked. If the question is asked on this part, is our expectation or our opinion that question shall be asked on differences or carve-out part of the chapter 2, which is on Ind AS. So most probably theoretical question will be asked. Now let's move on to the slides. Today we will be covering two Indian accounting standards, Ind AS 17 and Ind AS 19. Before starting with our session, let us I would like you to note the following disclaimer slides. Students are advised to refer to the study material, including supplementary study material, if any, and other relevant legislation for latest provisions, amendments required for forthcoming examination. These students are also advised to refer to e-lectures available on the students' LMS for this and other topics. These lectures are freely accessible on the institute's website, that is on Cloud Campus. You just have to register with your student's registration number and start learning immediately. For e-learning lectures, you need a student's registration number. However, for video lectures, you do not need even student registration number. Ind AS 17 leases vis-a-vis notified AS 19 leases. First of all, we will be covering this standard and the differences or significant differences in Ind AS 17 leases vis-a-vis notified AS 19 leases. First difference in the standard vis-a-vis existing or notified AS 19 is that Ind AS, the existing standard excludes leases of land from its scope. However, Ind AS 17 does not have such scope exclusion. It means Ind AS 17 covers the leases of land as well with other leases. However, AS 19 does not cover leases of land. Ind AS 17 also mentions specific provisions dealing with leases of land and building applicable. Let us have a brief idea about what are the specific provisions which are there in Ind AS 17. See, students, as we know in AS 19 and also in Ind AS 17, there are two types of lease, mainly operating lease and finance lease. For finance lease, a lease will be considered as a finance lease when the lease transfers ownership of the asset to the lessee by the end of the lease term, or the lease term is for the major part of the economic life of the asset, even if title is not transferred. So what is the economic life of the asset? That is land. Economic life of land is generally indefinite. So if it is not transferred, generally lease is not for an indefinite period. Maybe this is the reason. That's why AS 19 specifically excludes from its scope land as lease. However, Ind AS 17 says that land, there is no specific exclusion of land. It says when leases comprise of land and building, in that situation, what should be the provision? The specific provisions are there in Ind AS 17, which these when a lease has an element of land and building both. An entity assesses the classification of each element as a finance or as an operating lease. It means if a lease is having an element of both land and building, in that case, the whether the part of land or lease which is land is operating or finance lease, that has to be assessed separately or individually from the lease of a building. Though land and building are together a part of lease, but when they have to be classified and recognized in the books as per Ind AS, they has to be individually assessed. In case they are not able to individually assess them, or when it is individually assessed, minimum lease payments are allocated between the land and building elements in proportion to the relative fair values. Suppose we have a lease, say, in which minimum lease payment for yearly minimum lease payment is 6 lakhs, and it constitutes the lease for land and lease for building. In such a situation, what will be the amount by which lease of land and the lease of building be recognized, because these has to be separately recognized in the books, though there is one lease. So in that case, we have to consider the fair values of each element, that is land and the fair value of building, and in the proportion of these fair values, this minimum lease rental has to be, minimum lease payments has to be apportioned. Okay. Now in case where you are not able to, if lease payments cannot be allocated reliably between these two elements, then the entire lease is classified as finance lease unless it is clear that both elements are operating leases. It means if you are not able to classify individually land and building, or not able to recognize land and building, then if the lease is considered as a finance lease, in such a situation, the total lease will be considered as finance lease unless the total lease is considered as an operating lease. In another case, where for a lease of a land and building in which the amount that would initially be recognized for the land element is immaterial, where the element or the amount paid for land is immaterial and the lease consists of both land and building, in such a situation, that whole lease is treated as a single unit. And in that single unit, the economic life of the building will be considered as the economic life of the entire lease asset. Earlier, we are saying when a lease consists of land and building, they are assessed individually because the economic life of land is indefinite. However, building has a certain economic life. However, when in a lease, the amount paid for land, the lease of land is immaterial, then the economic life of building is considered, and the whole lease is considered as a single unit, so the economic life of building is considered as the economic life of the lease asset, and not the economic life of land is taken into consideration. This is one of the difference or major difference between Ind AS 17 and Notified AS 19. Second is definition of residual value. Sorry. The definition of residual value appearing in the existing standard. However, this definition has been deleted in Ind AS 17. First of all, let us understand what is the definition of residual value. Residual value as per AS 19 of a lease asset is the estimated fair value of the asset at the end of the lease term. In generally, what is the residual value? Residual means scrap value or the value at the end of the lease term. So this residual value is based on fair value, but same funda, that is at the end of the lease term. However, in Ind AS 17, we have deleted this definition. We have not continued with the definition of residual value. The specific reason, because other Indian accounting standards deals with the definition of residual value, and that definition will hold good even for this particular standard, that is Ind AS 17. Residual value is used in many other standards like in property, plant and equipment. So the definition will be there. So that definition, whatever the definition which is given in that particular standard or in any other standard will be considered as good and will be referred while discussing or while considering the residual value for the purpose of Ind AS 17. So Ind AS 17 is not having the definition of residual value, though this term is used in Ind AS. However, the definition of residual value is specifically defined in in existing AS 19 or notified AS 19. The third difference is in Ind AS 17, which is notified AS 19, is treatment of initial direct cost. Treatment of initial direct cost under Ind AS 17 differs from the treatment prescribed under the existing standard. Now, as we know, in leases, there are two types of leases. One is finance lease and other is operating lease. So, the treatment of initial direct cost for finance lease and for operating lease is different. Now, again in finance lease, there are two accountings. One is the accounting in the books of lessee and the one is the accounting in the books of lessor. So, what will be the treatment of initial direct cost in case of finance lease, in case of when the entry or when the accounting is to be made in the books of lessee? As per existing standard, this initial direct cost is added to the amount recognized as asset, because lessee has to pay the value. So whatever the direct cost which has to be paid, that is also along with the minimum lease payments. So that has to be added to the amount of the recognized as asset. How, and the same treatment is also mentioned in Ind AS 17. That means for finance lease in the books of lessee, initial direct cost has to be added to the amount amount recognized as asset in Ind AS 17 as well. However, in case of finance lease in the books of lessor, accounting is further classified into non-manufacturer, non-dealer and manufacturer or dealer. So let us first see what is the treatment for non-manufacturer, non-dealer in case of finance lease, in the books of accounting in the books of lessor. In case of finance lease in the lessor's book, initial direct costs either recognized as expense immediately or allocated against the finance income over the lease term. So, since the lessor will receive minimum lease payments, so that will be an income to the lessor, and if it incurs or lessor incurs any initial direct cost, then that will reduce the finance income or will be recognized as expense immediately. Okay, now if it is not recognized as expense immediately as per existing AS 19, then alternative treatment has also been suggested in AS 19, that is allocation of such initial direct costs against the finance income over the lease term. Over the lease term means you have to allocate that particular initial direct cost not in one particular year. You have to not expense off immediately. You have to amortize it over the years, and that amortization basis will be the basis on which you are recognizing the finance income in the books, or lessor is recognizing the finance income in his books. However, Ind AS 17 says interest rate implicit in the lease is defined in such a way that the initial direct cost included automatically in the finance lease receivable, there is no need to add them separately. So, in Ind AS 17, initial direct cost is included in the initial rate, interest rate implicit in the lease. So, what is the definition of interest rate implicit in the lease as per Ind AS 17? Ind AS 17 says the interest rate implicit in the lease is the discount rate that at the inception of the lease causes the aggregate present value of the minimum lease payment and the unguaranteed residual value to be equal to the sum of the fair value of the lease asset and initial direct cost of the lessor. It means that initial direct cost of the lessor is equal, is included in the sum which is equal to the total of the present value of minimum lease payment and unguided. So interest rate implicit includes this initial direct cost in Ind AS 17, and when it includes this initial direct cost in implicit rate, so no separate accounting, there is no need to have a separate accounting or to add them separately in Ind AS 7. Now, what is the treatment of initial direct cost in case of manufacturer or dealer when the lease is a finance lease and we are accounting in the books of lessor? As per existing accounting standard, this initial direct cost is recognized as expense at the commencement of the lease term. This term commencement, we will be explaining this term later on, is recognized as expense at the commencement of the lease term. However, as per Ind AS 17, as per Ind AS 17, the same treatment which is there in existing AS 19 is there in Ind AS 17. What is commencement of the lease term? Commencement of the lease term means the term from which the lease is started. You are using the leased asset or you are recognizing the asset on particular date. That is commencement of the lease term. Finance lease or lease assets are recognized on the date on the very first date when you start using particular asset under the lease. So that particular date will be considered as commencement date or commencement of that date will be considered as the lease term has been commenced. The treatment which is there in existing AS 19 is the same treatment which is there in AS 17 regarding treatment of initial direct cost for manufacturer and dealer in case of finance lease, in case of accounting in the books of lessor. Now we come to operating lease. Operating lease, again we are having two books. One is in the books of lessee and one in the books of lessor. In the books of lessee, what will be the treatment of initial direct cost for operating lease? Nothing has been mentioned in the standard. Similarly, in Ind AS 17 also nothing has been mentioned. They have kept silent. However, in case of lessor, in operating lease, they are defining it that initial direct cost is either deferred and allocated to income over the lease term in proportion to the recognition of rent income or recognized as expense in the period in which incurred. So two treatments have been given. Alternative treatments are there. Option is given to the lessor. Either you recognize as expense in the period in which it is incurred. It means immediately you expense it off. However, if you do not want to expense off immediately, you can create a deferred account and you can allocate this initial direct cost in proportion to the income over the lease term. However, in Ind AS 17, initial direct cost which is incurred by the lessor in case of operating lease, lessor accounts it by adding it to the carrying amount of the lease asset, because the lease asset will be will be shown in the books of lessor only. So that initial direct cost will be added to the carrying amount of the lease asset and recognized as expense over the lease term on the same basis as lease income. Whatever the minimum lease payments is received by the lessor from lessee, as and when he recognized the same in the books, he will also amortize that expense which is capitalized in the amount of lease asset. That a portion of initial direct cost which has been capitalized in the lease asset will be expensed over the lease term, over the years of the lease term on the same basis as income or in the same proportion. Now, because there are difference in treatment in initial direct cost consequent upon the difference between the existing standard 19 and Ind AS 17 in respect of treatment of initial direct costs incurred by non-manufacturer, non-dealer lessor in respect of finance lease. In case of manufacturer and dealer, we are having the same treatment. So the difference arises in case of non-manufacturer, non-dealer, and that too in case of finance lease. Difference arises in case of non-manufacturer or non-dealer in respect of finance lease. The term initial direct cost has been specifically defined in AS 17. However, AS 19 does not have a specific definition for initial direct cost. And also because in India 17, sorry, also because in India 17, initial direct cost is included in the definition of interest rate implicit in the lease. Therefore, the definition which is there for interest rate implicit in the lease in AS 19 is different, and the definition which is there in India 17 is different, and this difference is on account of initial direct cost which has been incorporated in the definition of interest rate implicit in the lease. In short, Ind AS 17 has been, the definition of interest rate implicit in the lease has been modified in Ind AS 17 to incorporate the initial direct cost, which was not there, which is not included in the definition of interest rate implicit in the lease in AS 19, notified AS 19. Next difference is on inception of lease and commencement of lease. Already I have explained you what is commencement of lease, but let us repeat it again. First of all, let us understand what is inception of lease. Inception of lease and commencement of lease. In inception of lease, this difference is marked out in Ind AS 17 only. Though inception of lease, this terminology, and commencement of lease, this both terminology is used in AS 19 also. This terminology is used in AS 19 also, but it has not been defined. However, in Ind AS 17, they have defined the difference of inception of lease and commencement of lease. As per Ind AS 17, the inception of the lease is the earlier of the date of lease agreement and the date of commitment by the parties to the principal provisions of the lease. Suppose, for example, lessor and lessee agrees to enter into a lease on 10th March. This is commitment date. This is commitment date. Lease agreement has been drafted and signed on today's date, that is 16th March. And as per the lease agreement, lease starts from 1st April So, earlier of these two, 10th March and 16th March will be considered as the inception of lease. So, 10th March and 16th March, inception of the lease will be considered as 10th March. So, as per Ind AS 17, the inception of the lease is the earlier of the date of the lease agreement and the date of commitment by the parties to the principal provisions of the lease. And the commencement, and similarly for Ind AS 17, definition of commencement of the lease term is that it is the date from which the lessee is entitled to exercise the right to use the lease asset. It is the date of initial recognition of the lease, that is the recognition of assets, liabilities, income or expenses resulting from the lease as appropriate. So, as we all know that on the very first day from the starting of lease, or when the lessor or when the lessee starts using the lease asset, it recognizes that lease asset in its book at fair value. So that date on which it recognizes, on that date at which it recognizes the lease asset is the date which will be considered as commencement date. And out of 10th and 16th March, earlier of the both, that is 10th March, will be considered as inception of lease. So I hope this is clear. Ind AS 17 makes a distinction between inception of lease and commencement of lease. Existing AS 19 also uses both the terms, but has not defined and distinguished what is inception of lease and what is commencement of lease. In Ind AS 17 deals with adjustment of lease payments during the period between the inception of the lease and the commencement of the lease. This aspect is not dealt with in the existing standard. In continuation, inception of lease and commencement of lease, as per Ind AS 17, the lessee shall recognize finance lease as assets and liabilities in the balance sheet at the commencement of the lease term. However, as per AS 19, the lessee will recognize the lease asset as per finance lease on the inception of the lease. So, whereas per the existing standard, such recognition is at the inception of the lease and not on the commencement of the lease term. However, this is the difference, that it means if we take the previous example, so as per Ind AS 17, lease asset in case of finance lease, asset will be recognized in the books on commencement date, that is on 1st April. However, as per existing AS 19, it will be recognized on 10th March. That is the difference in AS 19 and Ind AS 17. Both are on leases. Next definition is classification of current, non-current, classification of leases, liabilities. See, generally what happens, standard says that it will generally liabilities for lease assets are presented in the financial statement as a deduction from the lease asset. However, if your classification of lease asset and your classification of lease liability is different, it means you are classifying your lease asset as non-current, however you are classifying your lease liability as current. In such a situation, you cannot set it off, or it will not be appropriate for the liabilities for lease assets to be presented in the financial statements as a deduction from the lease asset. Suppose, as per the lease agreement, after the completion of lease term, that asset will be owned by the lessee. In such a case, lessee will represent that lease asset as a non-current asset. However, after a lease term, there will be no lease liability. So that liability and last year will be considered as current. So in such a situation, you cannot set off the current liabilities from non-current asset. You have to present it in differently. You have to show it separately. This is the difference between. However, on this particular issue, on the particular presentation, this particular presentation has not been addressed in the existing standard. The existing standard is silent on such type of classification, or when such classification differs. Classification of lease asset and classification of lease liability differs. And in that situation, what is to be done, how it is to be done is not dealt in existing standard AS 19. However, this has been discussed in Ind AS 17. They says it will not be appropriate for the liabilities for lease asset to be presented in the financial statement as a deduction from the lease asset. Next difference is sale and leaseback transaction. As per existing standard, if a sale and leaseback transaction results in a finance lease, excess if any of the sale proceeds over the carrying amount shall be deferred and amortized by the seller lessee over the lease term in proportion to depreciation of the lease asset. While Ind AS 17 retains the deferral and amortization principle, it does not specify any method of amortization. So the difference is in proportion to depreciation of the lease asset. Till this area, the definition is same in AS 17 and definition is same in as per AS 19. In AS 17 also says if a sale and leaseback transaction results in a finance lease, excess if any of the sale proceeds over the carrying amount shall be deferred and amortized by the seller lessee over the lease term. In AS 17 stops at this place. However, In furtherance to this definition, AS 19 also adds in proportion to the appreciation of the lease. So they are mentioning the basis. AS 19 is mentioning the basis on which their amortization has to be done by the seller for the amount which is difference in the lease sale proceeds over the carrying amount. Suppose in case of sale and leaseback transaction, you sold the asset to lessee you sold the asset for rupees 10 lakh. It was appearing in your books for rupees 9 lakh. So difference of this 1 lakh will be, if a sale lease results in a finance lease, if it is a finance lease, if any of the sale proceeds over the carrying amount shall be deferred and amortized. See, let me just have a reading of AS 19. If a sale and leaseback transaction results in a finance lease, any excess or deficiency of sale proceeds over the carrying amount should not be immediately recognized as income or loss. Means any loss that is 1 lakh will not be recognized as income. It has to be deferred, and that deferred amount will be recognized as income or loss in the financial statements of a seller lessee. It should be in proportion to the depreciation of the leased asset. However, this in proportion, this basis is not mentioned in Ind AS 17. They simply says this: the difference has to be deferred and has to be amortized in over the lease term. That's all. Next difference is accounting for incentives in the case of operating leases. This is the specific guidance given in Ind AS 17. Ind AS 17 in appendix, and this guidance is not there in AS 19. As per appendix, Ind AS 17 provides guidance on accounting for incentives in the case of operating leases. Now, what are incentives? Incentives are when there is a negotiation between lessor and lessee, and lessor wants to give lucrative offer to lessee so that the lessee enters into a lease agreement. They offer certain incentives. The incentives are in the form of upfront cash payment or the reimbursement or assumption by the lessor of cost of the lessee. Initial period, alternately, the lessor also offers initial period of the lease term may be agreed to be rent free or at a reduced rent. These such types of lucrative offers are said as incentives provided by the lessor to lessee so that lessee enters into a lease agreement. Now, what will be the accounting of such incentives? All incentives for the agreement of a new or renewed operating lease shall be recognized as an integral part of the net consideration agreed for the use of the lease asset. Suppose a lessor is providing any incentive, the value of that incentive comes to rupees 2 lakh. The value of value of incentive provided by the lessor. The total value of the lease which is entered as per the lease agreement is say about 30 lakhs. So when lessor will account this 2 lakh, what will be the accounting treatment of this incentive? So lessor has to reduce it from this value. All incentives for the agreement of new or renewed operating lease. In case of operating lease only, this treatment has been mentioned or this guidance has been given, shall be recognized as an integral part of the net consideration agreed for the use of the lease asset, irrespective of the incentive's nature or form or the timing of payment. The lessor shall recognize the aggregate cost of incentive as a reduction of rental income. It means this 2 lakh will be reduced from 30 lakh on a straight line basis unless another systematic basis is representative of the time pattern over which the benefit of lease asset is diminished. It means suppose the total value is 30 lakh and that 30 lakh is received in 5 years. So every year you are receiving 6 lakh rupees. So 2 lakh will also be amortized from the income on that proportion, that is for 5 years on a straight line basis. So 2 lakh divided by 5, 40,000 every year will be reduced from 6 lakh. That will be the way of accounting for incentives provided by the lessor. The lessee shall recognize the aggregate benefit of incentive. And now what will be the accounting treatment in the books of lessee? The lessee shall recognize the aggregate benefit of the incentive as a reduction of rental expense over the lease term on a straight line basis. So, because here for lessor it is the cost, that incentive which is provided by lessor to lessee is a cost, so it will reduce its income. However, for lessee, the payment or the lease minimum lease payment which is made by the lessee is the cost, but that incentive is income, so it will reduce its cost. So whatever he is paying, he is paying 6 lakhs. Out of that 6 lakh, 40,000 will be reduction of the cost, and for lessor it will be reduction of income. In general, sorry. In general, this reduction is on straight line basis. However, another systematic basis may also be used, which is representative of the time pattern of the lease benefit from the use of the lease asset. Means any other basis can also be used. It's not necessary that every time on straight line basis only this incentive has to be amortized. Any other appropriate basis may also be taken as listed in the standard. Next difference is recognition of lease payments. Ind AS 17 requires that in case of operating lease where escalation of lease rentals is in line with the expected general inflation, so as to compensate the lessor for expected inflationary costs, increases shall not be straight line. It means in case your value of operating lease or the minimum lease payments or the lease rentals which you are receiving in case of operating lease is escalating because of inflation, as so as to compensate the latter for expected inflationary costs, increases, that increase shall not be straight line. That increase shall be recognized in the books on the basis of the inflation criteria. Whatever the inflation index is there, on that basis that increase will be recognized. That will not be recognized on straight line basis. However, such type of guidance is not given in AS 19. AS 19 does not deal with such situations where your lease rentals are increased because of inflation or there is escalation of lease rentals on account of general inflation. As in every Indian difference, this is the common difference between Ind AS 17, or there's a common difference between Ind AS and existing standards, that disclosure requirements are much more than what is given in AS existing or notified standard. This is on account of getting better transparency. Ind AS are said to be more transparent than existing standards, and for being transparent, they definitely requires more disclosures. So disclosure requirements are much more in Ind AS 17 in comparison to notified AS 19. Now let us move to another standard, that is Ind AS 19 employee benefits vis-a-vis notified AS 15. The first difference in Ind AS 19 employee benefits vis-a-vis notified AS employee benefits is constructive obligations. In Ind AS 19, employee benefits arising from constructive obligations are also covered, whereas the existing AS 15 does not deal with the same. It means this constructive obligation has not been discussed in AS 15. Now, what is constructive obligations? In layman language, let us first of all understand what is constructive obligation, then we'll see the definition part of constructive obligation. In layman language, a constructive obligation is an obligation to pay that arises out of conduct and intent rather than a contract. Something which is not there in the contract between the organization, employer and the employee. We are dealing with employee benefits. So employer and employee, something which is not there in the contract between employer and employee. But still it appears from the behavior of the employer that a payment will be made by the employer or payment will be received by the employee. This appears maybe because of the conduct or maybe because of the intent, which you can see from some other behaviors of this. So that becomes a constructive obligation. This obligation may need to be shown in the balance sheet as a liability. Constructive obligation typically occurs from past conduct. For an example, I'm just not taking the standard. It is a simple example which I'm giving, which is one rank, one policy. Government said that they are considering or they are reviewing the demand of the ex or retired ex army men's one rank, one policy demand. Now they were simply considering or reviewing that policy. But because this step taken by the government becomes an obligation to the government that yes, you have to apply or implement that one rank one policy, our general expectation was arise that if government is considering or reviewing this demand, it means definitely they will be following this, so they will be implementing that policy. So it was not the intention of the government that they will do it or not, but because they were considering or reviewing it, it appears that yes, if they are reviewing it, it means they will be implementing. So it becomes a constructive obligation for government. Or for similarly, this is out of the context example, but I'm giving it just to explain you in a layman language certain how certain obligations becomes constructive obligations because of the intent of the employer, expectations of the employees increases or raises, which leads to a certain obligation when that constructive obligation has to be shown in your balance sheet. However, before going to the other differences, or let me explain this further. Before this, I just want to see in case we have any query on the previous standards which we have discussed. Yes, we are having certain queries. This is the question which was I have already answered in the starting of the beginning of this session. Please illustrate which type of questions are expected in exam. That is how questions can be asked. Generally, see students, this topic is very big. 39 Indian accounting standards are there, and you have to cover the summaries of all Indian accounting standards and also the differences in those Indian accounting standards vis-a-vis existing accounting standards, as well as carve-outs in India from IFRS. So since this is the first time this topic is made applicable for your May 16 examination, so we are advising you to focus mainly on differences in India's vis-a-vis existing accounting standard, and also to focus on the carve-outs in India's from IFRS. I would also like to add, please refer the criteria on which particular standards are India's will be mandatory for a particular company for a particular year. That also you should be aware of. So these differences are generally theoretical in nature. That's why I will advise you, or I expect that a theoretical question will be asked on this topic. What is the meaning of carve-out? See, the carve-out is a term used when there is a difference in India's vis-a-vis IFRS. IFRS includes international accounting standards, interpretation on those international accounting standards, international financial reporting standards, and interpretations on international financial reporting standards. It means, in short, IFRS includes four things. One is international accounting standard, that is IAS, and interpretations on IAS, that is SIC. Then IFRS and interpretation on IFRS, that is IFRIC. IFRS interpretations. So any difference in India's vis-a-vis IFRS will be considered as carve-out. Now, what is carve-out? Because of any change, because of economic conditions prevailing in India is different from the economic conditions prevailing in the outside country where IFRS has been formulated. So certain modifications has to be made in the IFRS while notifying it in the form of Ind AS. So that differences or modifications which leads to deviation from the provisions given in the IFRS will be considered as carve-out. There are certain differences which does not lead to carve-out. This is because IFRS may be having two options. They are prescribing two alternative treatments. Either of the one you can choose it while accounting in your books. However, Ind AS has said, no, you are not having an alternative, you have to do it in particular manner only. So this is not deviation from what is given in IFRS. This is basically restricting of particular provision. So this will not be considered as carve-out. Carve-out is where deviation is there in the provision. Some different treatment is there in IFRS and there is some different treatment in Ind AS. So that will be considered as carve-out. Next is as per Ind AS 17, from which date depreciation should be calculated, from inception date or commencement date. See, when you are recognizing the asset on the commencement date, how can a depreciation will be recognized in the books on inception date? However, in case of AS 19, because finance lease asset is recognized on the inception date, your depreciation will be also start from the inception date to the reporting date. However, in case of Ind AS 17, you are asking for Ind AS 17. In Ind AS 17, depreciation will start from commencement date to reporting date. Next, how do we have to prepare for those Ind AS which do not have corresponding AS, Ind AS 27, 29? When there are no differences, you are not required to study those standards for differences part. For differences part, something you cannot create it on your own. No? This is what is notified. This is a fact that there is certain provision is there in particular standard and certain provision is not there in IFRS or in the existing standard. So you cannot create it on your own. So which you cannot create it or develop it on your own. You are not required to standard. You just skip that those standard. That is a plus point for you that you have to not study that standard. As simple, but do not unnecessarily create your own differences. Please be on significant differences. Mention in exam, be very particular, point to answer to the point. Unnecessary vague answers should not be provided in the exam. That is wastage of your time as well as the examiner's time, and that will not give you marks. You will not fetch marks. So no need of doing so. Now we are not having any further query on this standard. So we'll be again moving back to our PPT. And once again, we are on the first difference on Ind AS 19 vis-a-vis notified AS 15. This is constructive obligations. I have already explained you in a layman language what is constructive obligation. Constructive obligation is an obligation which arises because of conduct and intent rather than a contract. So there is no legal binding, but because of intent, an expectation has been raised in the mind of employees that certain obligations will be discharged by the employer, so it becomes a constructive obligation for employer. This is as per legal language. Now, as per standards, see, we are here talking about Ind AS 19, but Ind AS 19 does not deal with the definition of constructive obligation. For constructive obligation, we have to look any other standard. So, Ind AS 37 deals with the definition of constructive obligation, and as per that particular Ind AS 37, constructive obligation has been defined as an obligation that derives from an entity's actions, where by an established pattern of past practice, published policies, or sufficiently specific current statement, the entity has indicated to other parties that it will accept certain responsibilities. And as a result, the entity has created a valid expectation on the part of those other parties that it will discharge those responsibilities. This is considered as constructive obligation. So, this behavior or content may be in the form of past practice, maybe in the form of published policies, or maybe on the form of sufficiently specific current statement, something which has been announced by the employer, and that current statement leads to that entity has indicated to the other party that it will accept certain responsibilities. It becomes a constructive obligation for the employer only when it raises that expectations in the mind of employee that certain responsibilities will be discharged by the employer. Let us have an example. What is constructive obligation? Sorry. A constructive obligation may arise where an entity has a history of increasing benefits for former employees to keep pace with inflation even where there is no obligation to do so. So, if inflation is the trend of the economic conditions of a particular country, and to keep in pace with that economic trend or keep in pace with that inflation, employer increases the salary in the form of DNS allowance. It increases the DNS allowance time to time or periodically. This is not because of any legal binding or someone is forcing them, but is on its own, the company feels that yes, the inflation is on a very high rate and they should compensate the employees for that high inflation. So that is constructive obligation for the employer. It is not because of any binding. If it is not there in the agreement that they have to compensate that inflation, and still they are compensating for that inflation, then that is a constructive obligation. So as per Ind AS 19, employee benefits arising from constructive obligations are also covered, whereas existing AS 515 does not deal with the same. Definition of employee benefit. The definition of employee. As per the existing standard, the term employee includes full-time directors, whereas under Ind AS 19, the term includes directors. Now, by restricting only to whole-time directors, then the definition of employee as per existing standard is very restricted or narrow. It includes only whole-time. However, directors can be independent directors, part-time directors, whole-time directors, executive directors, anything. But giving only whole-time directors as employee, it means that existing standard as having the definition of employee that is very narrow. However, under Ind AS 19, they have only include directors. So directors when can be any director, full-time director, part-time director, executive director, independent director. So the definition of Ind AS 19 is wider. The scope is much more in Ind AS 19. One more difference between the definition part is that definition of short-term employee benefits, other long-term employee benefits, and past service costs as per the existing AS 15 have been changed in AS 19. In short, these definitions are there in both the standards, but the way it has been defined has been different, slightly different. I cannot say it is completely different, slightly different, especially for short-term employee benefit. Let me read out a definition. As per AS 15, short-term employee benefits are employee benefits other than termination benefits which fall due wholly within 12 months after the end of the period in which the employees render the related service. They are saying fall due within the 12 months and after the end of the period. However, when it comes to Ind AS 19, Ind AS 19 states short-term employee benefits are employee benefits that are expected to be settled wholly before 12 months after the end of the annual reporting period. It's not only the end of the period, it is the end of the annual reporting period in which the employees render the related service. It means they have, in the definition given in Ind AS is more clear and more specific than the definition which is given in existing AS 15. There can be two interpretations in what is the definition as per the definition given in existing AS 15, but to avoid that anomaly or to avoid that loophole, the definition which is given in short-term which is given in Ind AS 19 is more clear and more crisp and clear. Similarly, other long-term employee benefits and the past service cost, the definition of these two items has also been very clearly defined in Ind AS 17 in comparison to existing AS 15. Next difference is contractual agreement between a multi-employer plan and its participants. What is multi-employer plan? First of all, understand what is multi-employer plan. In this multi-employer plan means for retirement employee benefits, certain plan has been taken, and that plan is not by one employer. A group of employers have taken the same plan and they are investing in particular plan. Every employer is in there. There are 4, 5 or more than one employer investing in a particular plan, that is multi-employer plan. In that case, if that plan has some profit or loss, then how will it be accounted? The surplus or the deficit in that particular fund, how will it be distributed among all the employers which are the participants of that particular fund? Ind AS 19 deals with situations where there is a contractual agreement between a multi-employer plan and its participants that determines how the surplus in the plan will be distributed to the participants. So, in the existing AS 15 does not deal with multi-employer plans. However, Ind AS 19 deals with multi-employer plans, but Ind AS 19 deals with a situation where there is a contractual agreement. If there is no contractual agreement between a multi-employer plan, then Ind AS 19 also does not deal with that. and its participants that determines how the surplus in the plan will be distributed. In a multi-employer plan, whatever the surplus is or the deficit is in the plan, that is to be distributed, that is to be recognized in what proportion, and where to be recognized is to be recognized in profit or loss, or to be recognized in OCI. It is on the contractual agreement. This has been defined in Ind AS 19. A participant in a multi-employer plan with such an agreement that accounts for the plan as a defined contribution plan in accordance with paragraph 34 of Ind AS shall recognize the asset or liability that arises from the contractual agreement and the resulting income or expense in profit or loss. So whatever there will be because of that contractual agreement, there will be any resulting income or expense, then that has to be recognized in profit or loss if it is a defined contribution plan. This guidance has been given in Ind AS 19. However, this is missing, or this Ind AS AS 15 is silent on this. Next difference is participation in a defined benefit plan, sharing risk between various entities under common control. As per Ind AS 19, participation in a defined benefit plan, sharing risk between various entities under common control is a related party transaction for each group entity, and some disclosures are required in the separate or individual financial statements of an entity. Whereas the existing AS 15 does not contain similar provisions. It means existing AS 15 does not deal with the participation in a defined benefit plan, sharing risk between various entities under common control. So if there is no common control, then AS 15 deals with that participation of defined benefit plan and the risk sharing. However, if there is under this defined benefit plan is under common control, and the matter is how to share the risk between various entities, then AS 15 is silent on this. How to deal with that? AS 15 does not state anything. However, in AS 19 states that participation in a defined benefit plan, sharing risk between various entities under common control is a related party transaction. So you have to refer to the standard relating to related party. In existing standard we have AS 18, but neither AS 18 talks on this, neither AS 15 talks on this. But in AS 19 for employee benefit, they says कि such participation under common control, those participants who are under those participants who are investing in defined benefit plan which are under common control, those all participants will be considered as related party to each other, and the transaction between them has to be separately disclosed in their financial statements. Whether it's a separate or individual financial statement, they have to disclose if any transaction has been done among those parties who are under common control of a defined benefit plan. Next difference is qualified actuary. Ind AS 19 encourages but does not require an entity to involve a qualified actuary in the measurement of all material post-employment benefit obligations. Whereas the existing standard, though does not require involvement of a qualified actuary, does not specifically encourage the same. So, sorry. Ind AS 19 encourages but does not require an entity to involve a qualified actuary in the measurement of all material. See, for measurement of post-employment benefit obligations, we require, standard says we need a actuarial valuation. For that actuarial valuation, who will do that actuarial valuation? This is not mentioned in either of the standard, not in Ind AS 19, not in existing standard. However, Ind AS 19 indirectly encourages that if that actuarial valuation is done by a qualified actuary in measurement of material post-employment, then it will be better. It encourages to have a qualified actuary for actuarial valuation of such post-employment benefit obligations. However, existing standard does not require involvement of a qualified actuary. They simply says we need an actuarial valuation for this. Whatever the actuarial value of that particular post-employment benefit obligation is there, that has to be taken into consideration. Neither a mention of qualified actuary is there, nor in any other indirect sense we are encouraging to have a actuarial valuation from a qualified actuary. However, Ind AS 19 wants, if your actuarial valuation, if it's done by qualified actuary, it will be better. So it somewhere encourages to hire a qualified actuary for valuing the post-employment benefit obligations. Next difference is recognition of actuarial gains and losses. Actuarial valuation is based on certain assumptions. Changes in these assumptions give rise to actuarial gains and losses. For example, changes in estimates of salary or medical costs. Existing AS 15 requires recognition of actuarial gains and losses immediately in the profit and loss. However, Ind AS 19 requires that the same shall be recognized in other comprehensive income and should not be recognized in profit or loss. So what is actuarial valuation? Actuarial valuation is based on certain assumption, because actuarial valuation is for future plan value of the particular defined benefit obligations, post benefit obligations. Sorry, post employment benefit obligations, future value of the fund that is estimated from actual valuation, and for that estimation we have to make certain assumptions. Everything is not readily available in the market, data is not readily available, so based on certain assumptions this valuation is done. However, that assumption should be valid and logical. Now, if certain assumption we have made this valuation this year, however, because of certain changes in the facts or in the assumptions, later on in next year that valuation which is done in the previous year changes, and the valuation which is done in this year is different from the valuation which is done in the previous year. So this will give rise to what? Actuarial gains and losses. For example, changes in estimates of salary or medical cost. Once we made actuarial valuation, we increase that 5% increase in the salary will be done every year for every employee. However, due to inflation trend, we were not able to increase only 5%. We had increased the salary by 6% or say 7%. In that case, the estimate which we made previous year is the base of that estimate is different, and the base of the estimate in this current year is different. So your actual valuation will also be different for both the years. So the difference of those valuation will give rise to actuarial gains and losses. Now, what will be the treatment of that actuarial gains and losses? That actuarial gains and losses, as per existing AS 15, is to be recognized in profit and loss immediately in that particular year where with that difference arises. It means current year's value actuarial valuation minus previous year's actuarial valuation. If it results into profit, it has to be recognized in P&L. If it results into loss, it has to be charged in P&L of the current year. But Ind AS 19 requires that same shall be recognized in or other comprehensive income. It means in the OCI, in the statement of profit and loss, in the second part of the statement of profit and loss, that is OCI. OCI, it has to be recognized either as profit or loss depending on what the difference results into. So this is the difference between Ind AS 19 and AS 15. Another difference is, now let's on move we'll be quickly moving to the other differences, and we'll be not able to cover other standards since because of time, and we are having a next mentoring session at 3 o'clock. Let's move on to the remaining differences quickly in the standard. Discounting of post-employment benefit obligations. As per Ind AS 19, subsidiaries, associates, joint ventures and branches domiciled outside India shall discount post-employment benefit obligations arising on account of post-employment benefit plans using the rate determined by reference to market yields at the end of the reporting period on high quality corporate bonds. In case such subsidiaries, associates, joint ventures and branches are domiciled in countries where there is no deep market, in such bonds, the market yields on government bonds of that country shall be used. It means where the market data are not very reliable, or the bonds there's very fluctuating, the rates are very fluctuating, then that in that case we cannot say that is a deep market, that is not a stable market. In such situation, the rates market yields of government bonds should be taken as a base a base for determining the discount rate. However, as per AS 19, we always says that you have to take the rate of market yield of the government bond for considering or determining the discount rate. Existing AS 15 sticks on the government bonds. However, in AS 15 gives an option first to rely on the market yields of the market or the high quality corporate bonds. If you are not able to find that high quality corporate bonds, then rely on the government bonds. So this is for primary and this is secondary. First look into this portion. If you're not getting this high quality corporate bonds, then look on to government bond. But AS 15 says now you have to see only government bonds or market aims on government bonds. This is the difference in AS 19 and AS 15. Next difference is financial assumptions. Ind AS 19 makes it clear that financial assumptions shall be based on market expectations at the end of the reporting period for the period over which the obligations are to be settled, whereas the existing standard does not clarify the same. It means for financial assumptions, any base market expectations or of the reporting period, whatever the base you find logical, you can take. However, Ind AS 19 specifies that yes, you have to take market expectations as the base for financial assumptions. Your financial assumption should be based on market expectations. Next is timing of recognition of termination benefits. Under Ind AS 19, more guidance has been given for timing of recognition of termination, or detailed guidance is given for recognition of termination benefits. However, recognition criteria for termination benefits under revised standard differ from the criteria prescribed in the existing standard. Guidance on interaction of ceiling of assets recognition and minimum funding requirements. Ind AS 19 gives guidance on such items like interaction of ceiling of assets recognition and minimum funding requirements in the case of defined benefit obligations. These things are dealt with when you are dealing with defined benefit obligations. However, such guidance is not there in the existing standard. So let's move on to the queries we are having on this particular standard. Total Ind AS are 39, and how many Ind AS are available for notified AS? See, we are having right now 29 notified accounting standards, and we have notified Indian accounting standards. They are 39. So definitely there are certain standards on which we do not have notified Indian. There are certain notified Indian accounting standards on which we do not have notified accounting standards. So certain standards will not have any difference. Like Ind AS 41. Agriculture, we do not have any corresponding existing accounting standard, so there will be no difference in that. But however, there are certain standards, though we do not have direct direct existing standard, but the provisions which are there in the Indian accounting standard has been somewhere dealt in any other related related existing standards. So we have to take into consideration. So that is specifically mentioned in the supplementary material and also in the January 16 edition of the study material. The differences which are there in a particular Ind AS and the differences which are there, which are not there in the AS. So you have to study accordingly. What is the meaning of convergence? See, students, convergence is to adopt something with certain modification. Adoption is using or taking out something as it is without any modification. That is adoption of. So we have not gone for adoption of IFRS, we have gone for convergence of IFRS. We have a standard equivalent to IFRS converged standards. Ind AS are considered as IFRS converged standard. And this term convergence is used because we are not adopting, we are not notifying IFRS as it is. We are making certain changes based on our economic environments, based on the practices which are followed in our country. So based on that, certain modifications has been made in the Indian accounting standards. That's why we are not saying it is adoption, it is convergence. Convergence means certain modifications has been incorporated. Minor differences done just to define why this is because we have carve-outs. So the reason for carve-outs makes it that we are converging into the standards. We are reading and reviewing the standards based on our economic scenario. Theory questions like state the major differences between Ind AS 19 and AS 15 or explain carve-in, carve-outs and give examples of each. Are such type of questions expected? See, I don't think examples will be asked in the questions. How? But what is your first part of the question? That may be asked, that state the major differences between Ind AS 19 and AS 15. That can be asked. That can be the way of asking a particular question in an examination. That probably, it's not necessarily the similar way of asking will be there, but this can be the way. But examples of particular differences, this is your choice to explain the exact difference you have. If you want to give the example, you can give, but I don't think that will be asked specifically in the exam. So students, in case, I hope you have taken the maximum benefit of this mentoring session, and in case of any further doubts which you were not able to raise it right now, and you find it later on with studies, you come out with some doubts on these two standards, you can mail me on my mail ID, which is shilpa@icai.in. My contact number is 0120 3045 916. For any general queries, you can call me over the phone, and for technical queries, I would prefer if you mail me on my mail ID, which is shilpa@ici.in. Hope you have taken the benefits and you'll use that the knowledge acquired in this session for your examination purpose, and your studies on this topic will be easier after listening to this mentoring session. So all the best. Have a better preparation. Thank you.